Bank of America out with its fund manager survey for the month of March. The bank identifying short European equities as the most crowded trade now. A fascinating survey by the guys over at Bank of America. And as always, I'm pleased to say that Jared Woodard joins us now. Bank of America Merrill Lynch global investment strategist. Your thoughts, Jared, on the new top one crowded trade, the number one? What's behind it?
I mean, people hate Europe. And why do they hate Europe? Well, because there's no growth, there's no upside, there's no inflation. It's back to secular stagnation, back to a low growth, low interest rate world. That's the clear message across the board from this survey in every part of asset allocation. We think that the pain trade for equities in the next 6 months is up because people don't own stocks, because cyclical, profit indicators are starting to bottom out. We're seeing green shoots in China. And the survey tells us that a lot of investors are a little bit behind if that's the view. The equity allocation's lowest, bank allocation, hedge fund leverage, all lowest since the Trump election. People have given up on that big growth policy, populist, get back into the game kind of trade, and they're back into a shell-shock defensive position.
So let's talk about, first of all, the big short in the fund manager survey. First Europe, a little bit more. Then we can develop the ideas for the broader market and for the US market specifically. What's interesting to me is incrementally more and more people started to come round to the idea of being long Europe. And I sat asking myself last week just how contrarian this was, because European markets have actually performed pretty well, regardless of how many people want to get behind it, Jared. Is it a contrarian trade or not?
I think if you look at flows data, which we do every week, if you look at where people are positioned, if you look at the bigger picture macro data, there is not a lot of ownership of European equities. I mean, people hate the asset class. They'll tell us, and I think part of that is because the China cycle has really hurt. So to the extent that we're still looking for green shoots rather than a full-on massive recovery in the Chinese economy, I think there's still tons of opportunity in the long Europe side. What
came out of this survey that was also interesting to me, if you take the top three, just in terms of the most crowded trades from your survey, short European equities, long the US dollar, and then you had this long FANG BAT, long EM, rounding out 3 and 4. The low conviction behind these crowded trades, these aren't high conviction trades like they used to be, are they?
That's true. I mean, I would group the kind of China risk, Europe story, even strong dollar story as in some sense interlinked. I mean, why do people own tech? Well, they own tech because there's no growth anywhere else. So short Europe. I mean, these are all related. And if you did see a rebound in China that coincided with some kind of a fiscal response in, let's say, Germany, fingers crossed, I think the market could reverse itself really quickly.
It's interesting that you can have simultaneously the most crowded trade being long EM and short Europe at the same time, when most people, to your point, if you get some kind of solution in trade, for instance, perhaps the ultimate proxy for that is German equities. Can you reconcile the two things, to be that short Europe, but to be that long EM?
Long EM here does not mean long Chinese equities. It means Latin America, and to some extent, emerging Asia, excluding China. That's been the trade the last 6 months. If you do see a trade deal, if more importantly, I mean, it's really not about trade, it's about Chinese domestic economic growth. If you see stabilization there, then I think you see the DAX go to the moon.
So let's round it out and put a bow on it. For you, the pain trade, and for Bank of America and the team there, the pain trade is stocks go higher. There is no greed to sell.
Right.
A few percentage points from a record high. There will be some people watching this that struggle to absorb that message. Just make sense of it for us.
Well, look, people don't own equities. People have been really skittish and skeptical. We expect that S&P 3000 10-year yield dragged higher to 3% will generate some greed and get investors on board. It's always a wall of worry. And in this case, folks are positioned so defensively. They hate cyclicals. They hate banks. That if you do see stocks continue to march higher, that'll get more people involved, and that's how you get a summer peak.
So you do think we can get both the S&P 500 at 3,000 and the US 10-year yield back to 3%. You can reconcile those two things. They can sit comfortably with each other.
Well, they can. I mean, if you look at what happened last year, you saw 10-year creep above that level. It couldn't hold it because we didn't have the policy response and the economic growth required to hold it, and that'll probably happen again this summer.